Okay. So we have done so much about the group accounts, but the last thing that we need to talk about now is what we call the intra-group transactions. Okay, intra-group transactions. So there can be some kind of uh, activities that will be between the parent and then the subsidiary. It can also be between the parent and then the associate. It can be between the associate and then the subsidiary. How do we go about those ones? Okay, one of the intra-group trading, which is very common, is going to one of the intra-group transactions, which is common, is what we call the intra-group trading. Okay, intra-group what? Trading. Okay, one of the common one is the intra-group. Okay, let me just say intra-group transactions. Intra-group transactions. Then we now have the intra-group trading as one of them. So we have the intra-group trading. So we have the intra-group trading. We also have transfer or a sale of PPE. Transfer, or we can have transfer or sale of PPE or property, plant, and equipment. We can also have issues of investment property where the parent will be renting out uh, a PP to what, or investment property to the subsidiary. We say that if that happened at the group level, the property is being occupied by the what? By the group itself, because the subsidiary is part of the group. Okay. So we can also have issue of investments in loan. Okay. Or let me just say investment in what? In investment in uh investment in financial liabilities. So let me just say investment in financial liability. So the parent can also purchase the preference shares, or can also purchase part of the loan notes. Okay. Then we also have intra-group balances. Intra-group balances where the parent will be owing the subsidiary, and the subsidiary will also be owing the parent. How do we go about that? We, at the end of the day, we cancel it. So we'll be taking the first one, which is the intra-group trading. Intra-group trading, which is one of the common ones that you are going to be seeing there. Intra-group trading. There cannot be a group account or a group account question, and there will not be any intra-group trading. Okay. What do we mean by intra-group trading? What we are talking about over here is that if company A is the parent, company A is now giving goods to company B to sell on their behalf. Okay. So if A is the what? If A is the parent in Ghana here and B is in Nigeria, okay, we are buying B in Nigeria so that we can sell through the what? We can sell to the Nigerians through the B. Okay. So whatever goods that we are giving to B, we are not selling to B. We are giving the goods to B to sell on our behalf to what? To the Nigerians. Okay. So if you also come here, if you take A and B, if A is the parent, you can just assume that A, which is a parent, and this is a subsidiary. Okay. You can see that if A is giving goods to B, the B is seen as what? As a branch of the what? Of the parent, which is the head office. Okay. So if you are now moving goods from your head office to your branch, you are not selling to them. You are just giving the goods to them, or you are just moving the goods to that place to sell to what? To the customers or to people that are going to be buying there. You are not selling the goods to what? To the B. You are just giving the goods to the B to sell on your behalf. Okay. What happened is that these people are going to be keeping individual records. Okay. These people are going to be keeping individual records. They are going to be keeping individual records. In their individual records, they will be recognizing this as a sale. Okay. But if you are coming to put the two together, we cannot say that these two are going to be what? These two are going to be selling the same item. No. The goods that we are giving to you, if we are giving you 10,000 goods, okay, or the 10,000 worth of goods, or the 10,000 units, we are giving you 10,000 units of the goods, okay. A cannot recognize this as sell, and B will also recognize the same item as sell. No, that is not a sell. We are giving the goods to them to sell on our behalf. Okay, so if the A or the B is able to sell all the goods, fine. If they are not able to sell all the goods, they'll return the rest to us. It's just like you are giving an item to your friend to sell for you. Okay, so the sell for your friend, the sell made by your friend will become your sell. What does it mean? Your friend will return the items or the unsold items to you. That is how it works. So let's take an example here. Let's say that A bought the items. Okay, so let's say that the item given to, so A will recognize, let's see, the sell, okay, is, let's say, 1,000 units, and each unit is what? Is 100 cedis. Okay, so each unit is 100 cedis. Okay, but the cost, this particular item costs what? It costs them 80 cedis. Okay. Okay, since if these goods has been transferred to B, who is a subsidiary, it can be the subsidiary selling to what? To the A. It can be the parent selling to the subsidiary. Any of them, the treatment is the same. Okay. So what will happen is that in their separate books, what A will be saying is that A is going to be recognizing. So in the books of A, which is the parents, so in the books of A, which is their individual books, in the books of A, okay, A will be having a revenue of what? What will be the revenue in the books of A? In the books of A, what will be the revenue? They are now transferring goods of 1,000 units at 100 cedis.
100,000.
100,000.
Okay, so that will be 100 units multiplied by, okay, this will be 100,000. Okay, their cost of sales will be what?
80,000.
Okay, their cost of sales will be 10,000 units multiplied by 80. Okay, so they'll be recognizing a profit of what?
20,000.
Okay, 20,000. So this will be their profit on the sale. Let's come to the books of what? In the books of what? In the books of B. In the books of B. Okay. In the books of B, what will happen is that let's assume that B was able to sell only 800 of these goods. Okay, B was able to sell only 800 of these goods. So they are able to sell only 800 of these goods. They will be having revenue. They'll be having revenue of 800 multiplied by what? 100. Okay, in most cases, the other party, okay, in most cases, the other party supposed not to make what? Profit, because you are selling the goods on behalf of the other party. So if you are giving the goods to your friend, the best that your friend can get is commission. Okay, so your friend will sell the goods at the price that the goods has been given to them. Okay, if you send goods to what? To a branch, okay, the branch will sell the goods at the selling price given to them by what? By the head office. Although the branch can also put a certain amount of money on it. Maybe they might incur other costs to process the goods, or they might incur other costs to what? To make the goods available for what? Available for sale. So they also want to recover that particular amount from what? From the sale. That can happen. Okay. But the goods they are going to be selling at the price given to them by what? By the what? By the parents. Although they can sell more than that to if they have incurred other costs that they want to recover. Okay. But if you want to account for this particular one between the two parties, the sale will still be at what? At 100. Okay. So this will now be 80,000. I hope we are okay with that.
Yes.
Okay. And their cost of sales. Okay. Their cost of sales will be this one. So let's get the cost of sales very well. The cost of sales will be 80,000. Okay. Minus 80,000 minus what? 200 multiplied by 80 is what? They will recognize all the purchases, then they will take the closing stock from it. What are they going to be having?
It would have been 100,000 minus 20,000 rather.
Okay, 100,000, sorry. So their cost of sales will be 100,000. They will buy their goods at, okay, so that will be 100,000. Thank you. Okay, minus what? 20,000, isn't it?
Yes.
Okay. And their cost of sales will still be what?
80,000.
Okay. That's why I'm saying that these people is supposed not to make what? Profit on the sale. So they are giving it is just like head office giving goods to branch. So you sell it at the price given to you, as a price that has been given to you. So you don't go and sell more than that. Although they can sell to recover part of what? Maybe a cost that they have incurred on maybe transporting or making the item ready for what? Ready for sale. And they will have to recover that one. Okay. That can also be the case. But whatever happens, the transaction between the two parties will be at this one. So assuming you have given these goods to your friend, okay, you have given these goods to a brand to sell. Are you going to be saying, if you are preparing the account for the group as a whole, which will be the head office and yourself, are you going to be saying that the goods you have sold all the 1,000 goods? If you are preparing an account for the year now, are we going to be saying that we have sold all the 1,000 goods?
No.
No, the goods that has been sold is 800, isn't it?
Yes.
Okay.
Yes.
So what will be the issue now over here is this one. Okay. The goods that has been sold. Okay. The sales for the group will not be the sales made by the subsidiary. Okay. Because the goods is 1,000 and the subsidiary is selling the goods on behalf of the parents. The subsidiary is part of the group. So the goods that we have dispatched to the subsidiary, only 800 has been sold. So we have sold only 800. We have to recognize profit on what? On only what? Only 800. But look at what is happening over here. In the books of the parent is recognizing what? It's recognizing all the 100,000, isn't it?
Yes.
Okay. So what do we have to do to have only what? Only 80,000. We have to come and take the portion of the goods that have no, the revenue relation to the portion of the goods that has not been sold, isn't it? Okay. So we come here and come and take what? 20,000, because the goods that is left is what? Is 200 multiplied by 100. That will give us 20,000. Okay. The cost of sales over here, which is 80,000. Okay. We are recognizing all the 80,000. So what do we have to do? We have to take the cost of the remaining goods that has not been sold. Would that give us 16,000?
Yes.
Okay. So what will be? Okay. Let me come here to this place. Okay. The parent is having this. So the parent is having a revenue of 100,000 in 8 books. Okay. The parent is having a revenue of 100,000 in 8 books, but the goods that has been sold is only 800. So the revenue that the parent should recognize should be what? Should be only 800 multiplied by 100. So these goods has not been sold. Okay. 20,000 has not been sold. So we need to have a sale of what? 80,000. Cost of sales that the parent was recognizing 80,000 in 8 books. 200 of the goods has not been sold, and the cost is what? 80. So that will give us 16,000. So we take the 16,000 over here to know the cost of the goods that has been sold. What are we having as the 64,000? Okay. What will be the profit now?
16,000.
Okay, 16,000. Okay. You can see that the profit on the sale of one quantity is 20, isn't it?
Yes.
And we have sold 800. So 20 multiplied by 800, that will give us 16,000. Okay.
Yeah.
So you have to adjust this. Okay. But this is what will normally happen in the exam hall. Okay, let's come here. They are going to be giving you their sales figures, their individual sales figure. So let's come here and see we are having the group account. Okay, we are having a group account. We'll be having revenue, okay, of 100,000 plus what? 80,000. Do you agree?
Yes.
But
Yes.
these two people are selling only one type of what? Only one type of item. How can two different people be selling one item? Okay. So this person is saying that they are selling it 80,000. This also say they are selling it 80,000. No, that is a sell within the group. Okay. So the sell for either the subsidiary or the buyer, the sell for the buyer becomes the sell for the group as a whole. Because if you give goods to a branch, the branch will sell it and give the money back to you. Okay. So you have sent what? But they are recording this as a sell because they are keeping their individual records. But if you come to the group, if you come to now compiling their records, okay, the sell for the group will now be the sell for what? The sell for the buyer, the sales made by the buyer. Okay, because you are giving the goods to the person. Since you are keeping records, you are also saying that you are transferring goods at 100,000. That person will also record that particular because they are in business, they have to keep records. But if you are putting the two together, the sell for this one will become the sell for the other. So let's come here. This is what will normally happen. So let's come to cost of sales. Okay, let's count the cost of sales here. The cost of sales over here will be 80,000 plus 80,000. I hope you're okay with that.
Yeah.
Okay. You can see that the 80,000 for the subsidiary is going, isn't it?
Yeah.
This and this will cancel. All right. What happened over here is this. Okay. The 2,000 worth of the goods has not been sold. Okay. 2,000 worth of the goods has not been sold. So we take it over here and we have what? 80,000. Okay. Then we come here, the cost of these goods, 20,000 that has not been sold. Its cost is what? 16,000. Okay. Oh, this will be 160,000 rather. Okay. So 160,000. Okay. So this one too will be what? Would that be 134,000?
144.
Okay. 144,000. Okay. And the profit will be 16,000, isn't it? Is that correct?
Yes.
Okay. Let's come here. Let's come here. Okay. Let's come here. We can see that we are taking 20,000 from this place and we are taking 16,000 over here. Okay. The difference between the two is what?
Is it 4,000?
Okay. The difference between the two is 4,000, isn't it?
Yes.
Okay. This 4,000 is what? 200 multiplied by 20. Okay. The goods that are here to be sold, the profit element on it is what? Is 20. So 200 multiplied by 20, that will give us 4,000. This is what we normally do. Okay. We cannot go here and do this. Okay. But we know that we're supposed to take what? We're supposed to take 20,000 from this place and take 20,000 from, and take 16,000 from this place. What we do is that we can actually ignore the 20,000 over here. Okay. Because we know that if we take this and this from it, we are going to be having this, we are going to be taking 20 over here and be taking what? 16 over here. So what we do over here is that, okay, let's not take the 20. Let's make sure that we have 20 over here so that 20 against 20 will now be 0. So this is what we normally do. So you come here and you have this one. So you add the unrealized profit to this one as what? As 4,000. Then you leave this particular one. Okay. Then you leave that particular one. Why are we leaving it? You can see that we're supposed to take 16,000 over here, but we didn't take it. So adding the 4,000 now will give us 20,000. That's supposed to be taken from that particular one. So we gross the cost price to the selling price so that the revenue against what we grow. we put the profit and then the cost price together to have revenue so that it will be 20 against 20. Then we'll still be having our what? Our this one to be 0. So we have 180,000 over here. Then this will be against 164,000. Okay. You still be having your profit as what? At 16,000. So this is, we add only the unrealized profit to the cost of sales. Why are we adding? We should have subtracted the profit, we should have subtracted the selling price from revenue, but we are not subtracting it. So the selling price is there. How do we make sure that the selling price is the same as the amount that we are going to be subtracting? So we gross our cost also to have a revenue so that the revenue against revenue will give us 0 at the end of the day. So we just make this one to be the revenue at the same as the 20. We're supposed to take 16, but we haven't taken that. We are adding 4,000. That is now giving us 20,000. We're supposed to take 20,000 over here. We haven't taken it. So it means that 20,000 over here against 20,000 over there. Okay. So we have 16,000. But this is not what you are going to be doing. And this is not what the standard is saying that we should do. Okay. So this is just a way of showing you what we mean. Okay. What we mean by the intra-group trading. This is what the standard will be telling you to do. Okay. If we have this, the standard says that we should assume that there cannot be cells within the same group. Okay, so there's no cells within the group at all. So let's remove the cells. So assume that no cells occurred within the group. Okay. So how do we go about that? That is also a very simple situation there. Let's come here. Okay. If you are doing the group accounts, we are going to be having a revenue of what? 100,000. Again, 100,000 plus 8,000. Is that correct? Okay. Then we have our cost of sales to be 80,000. Okay. Plus 100,000 minus what? 20,000. I hope that is correct.
Also correct.
Okay. Let's come here. This is what the standard is saying. Okay, the standard is saying that there cannot be any cell within the group. So it means that the parent is not selling to the subsidiary. They are only giving the goods to the subsidiary to sell on their behalf. So what we do over here is that we remove the what? We remove the sales made by the parent. The parent is not selling. You are only giving the goods to the person to sell on your behalf. So you can't recognize that as a sale. The sale will now become the sale made by the person who is selling the item on your behalf. So if you are giving a goods to your friend to sell, your friend will sell it. But since you are keeping records, you also write that as a sale. And your friend will also recognize that as well as purchases. But your friend will sell the goods and return the remaining one to you. The sale made by your friend is now the sale for you. So you have to go and adjust the first thing that you have recognized as a sale. So you go and remove that. Okay, I haven't sold to my friend at all. So you now recognize that the goods sold by your friend as what? As the sale. So the standard says that we should remove the sale. The sale is the total sale. The parent is selling at 100,000. So the parent is supposed not to sell. They are only transferring. So we remove the 100,000 to now have what? 8,000. So we come to this place and also remove what? Remove the 100,000. Okay. We also come here and remove 100,000. Okay. Let's come here. Let's pay a typical attention to this place. You see that the sales over here will be what? The sales now will be 80,000. Is that correct?
Yes, sir.
Okay.
Yes, it is.
Okay. Let's come here. Okay. You can see that if the 100 against 100 over here is 0, isn't it?
Yes.
Okay. But what is the 100 against 100 over here is 0. So this will now be 8,000 minus what? 20,000. Okay. But what is the what? You can see that the closing stock is now valued at what? At a selling price. Okay. But the cost of the goods that are here to be sold is actually 16,000. Do we agree with that one?
Yes, we do.
Okay. So we should have subtracted only 16,000 from the 80,000. But we have subtracted how much?
20.
20,000. So what do we do?
We add back 4,000.
We add back 4,000. Okay, so you come and add back 4,000 over here. You come and add back 4,000 over here. Why are we adding the 4,000? We are adding the 4,000 to neutralize the what? The effect of the closing stock. The closing stock should be valued at what? At cost. Okay, this is an inventory. Inventory should be measured at lower of cost or net realizable value. The cost is 16,000 and you are having what? 20,000 as a closing stock. No, go and reduce it. So we come and add the unrealized profit. Okay, so this is not a selling price. This is not a selling price. How do we make it what? Cost price now? We are subtracting. Okay, so if you are subtracting 200,000 and the cost price supposed to be a value lower than that one, and the profit on the item is 4,000, you now come and add the 4,000 to reduce it to now negative 16,000, which will be the cost price that we are subtracting. Okay, but what will happen over here is that the inventory in the statement of financial position of the subsidiary will be valued at 200,000. They will still be valuing the inventory as what? As selling price. But the inventory should be valued at what? At cost price. So we go there and subtract the 4,000 also from that. Okay, let me just pass the entry for this one. Then we just continue and see. Okay, if you have the unrealized profit, this is a very simple issue. Okay, provision for unrealized profit. I'm saying that there cannot be a situation where you have a group account without what? Without this particular one. So this is what you do. The first thing is that you remove the what? You remove the cells. Sometimes they can give you the cells for monthly basis, or they can give you the cells as month. So remove the cells. Okay. So you can see that the cells has been 2 million.
2 million.
Okay. Per month for. Okay. The question can say that the sales has been 2 million per month throughout the year. Okay. And the parent has acquired the subsidiary for only 9 months now. So if you want to know the post-acquisition sales, the sales that we remove is the sales that the parent made to the subsidiary after the acquisition. But the sales before the acquisition, that is a normal one. The parent is not transferring to the subsidiary. They are selling to the subsidiary in actual fact. But the sales that we remove over here is the sales that are being made to the what? To the parent or the subsidiary after the acquisition. Okay, after the acquisition, the parent is now the owner of the subsidiary. So anything that we are giving to them is just like we are giving them assistance or we are transferring something to them. Okay, but the sales that has been made before the parents acquire the subsidiary, those ones are normal sales. At that time, the subsidiary is a third party to the parent. So whether they are able to sell or not, it is none of the parent business. Okay, so they can say the sales was 2 million per month throughout the year. Okay, so you just multiply this one to have your total sales made. Okay, then you come here, what you do is that you debit revenue. Debiting revenue means that, okay, debit revenue with the what? With the total sales. Okay, you debit revenue with the total sales. Then what you do is that you credit cost of sales. Okay, cost of sales with the total sales. Okay, so the total sales, what we are doing is that we are removing the cost of sales recognized by the subsidiary. The subsidiary is going to be recognizing the cost at what? At the selling price. So we are removing that one as well. Okay, there will be an issue of the over deduction of what? Closing inventory over there. So what do? We now debit the cost of sales with the 4,000 that we had over there. Okay, with the unrealized profit. So let me just see the unrealized profit, or with the provision for unrealized profit. Okay, because we have subtracted selling price instead of what? Instead of cost price. So we go and add it and remove that particular profit element there. So we now credit our inventory. Okay, because the inventory will be carried at selling price instead of cost price. So we do this and we have this answer. Okay, what is going to be happening in the exam hall is they will mostly give you the what? The portion of the goods that is yet to be sold. Okay, if you are doing this for statement of profit or loss, this is why you remove it. But if you are doing this for statement of financial position, your attention will be only on this one. Okay, your attention will be only on this one. Okay, so you can see that they will be removing all the 20,000 from this one, and this will now be giving us a cost of sales of 60,000. So the profit will now be 20,000. Okay, the profit will now be 20,000 instead of what, 16,000. So there's a profit element in this one which is supposed not to be recognized. The total profit is 20,000. So it means that the goods that are here to be sold, the profit is also recognized. Okay, who is selling this? It is the parents. So the profit of 4,000, which is here to be recognized, will be in the retained earnings of the parents. Because at the end of the year, the profit for the year will be added to the retained earnings. So what we do over here is that we go, and if we are doing statement of financial position, we go and debit the group retained earnings over here instead of the cost of sales to remove the profit. The 4,000 profit is in the what? Is in the group retained earnings of the parents, because they are the one recognizing the 20,000 as a profit. The profit should be only 16,000. So let's go and reduce the 20,000 to 16,000. And this one, whether it is statement of profit or loss, you'll still be what? Crediting your inventory. You'll still be crediting your inventory. But what is going to be happening is that mostly they will give you markup or margin. Okay, they will give you markup or margin. So let's come here. Let's come to this particular one. What will be the margin over here, or what will be the markup there? The profit on each item is 20 cedi. So 20 over 100 multiplied by 100%. I'm having 20%.
Yes, sir.
Okay. So the margin is what? The margin is 20%. Okay. So they will always give you a margin. Okay. And they will give you, if you are doing statement of financial position, they will not give you the total revenue, because the total revenue is irrelevant to you. Okay. The only thing that we are going to be doing, the only adjustment that we are going to be doing is the profit that has been recognized by the parent or the subsidiary, any of them that is selling. That's supposed not to be recognized. So they will give you the portion of the goods that are here to be sold. So they will say the unsold goods at selling price, they will give you 20,000. Okay. So what will happen over here is that since they are recognizing this, it means that the parent is recognizing all the profit of what? In their individual books, they are recognizing all the items, like how we have done it. Okay. Then we ask ourselves, what is the portion of the profit that is here to be recognized? What is the portion of the profit that will be on the what? On the 20,000. Okay. So we have this one, and we have what? Would that be 4,000?
Yes, sir.
Okay, so this 4,000 is recognized in the retained earnings of the parent. So we just go and take what? And take the 4,000. Why are we taking the 4,000? It means that no adjustments has been made, and the parent is still recognizing the 20,000 as the profit, because that is what they have in their books as 20,000 there. But 20,000 of the goods are here to be sold. So it means that the profit element on that one is here to be what? Is here to be realized. But the parent has already recognized that particular profit in their statement of profit or loss. So you go and take it from that one. That is how we go about that particular situation. And that is what you'll be doing for the standard. Let's pick some examples. I have examples on issues like this so that we will not go and be doing something. So I have some examples here. Let's come to okay. So let's come to question 3. Okay, so I have three examples over here. So let's take all the 3 examples. They might be they might be different. Okay, so let's take all the first one is a 3. Okay, so Naveron, can you take that for us?
Sir.
Yeah.
Yeah. Please, I can't see the
Oh, really?
questions. Yeah.
Okay, I'm not sharing that one. Thank you.
Okay. So question number.
3. Let's take the 3 first, then we take the 4, then we take another one down there.
Okay. At 31st December 2021, our sole held goods in inventory, which had been supplied by Takwa, the parent, at a markup on cost of 35%. The goods had a cost. The goods had cost our sole 6.75 million. So please, I'm done.
Okay. Is it mean that I'm not taking the thing well, or at 31 December, our still had goods in event had been which had been supplied by Takwa
The
the
parent.
parent, okay, at a markup on cost of 35%. The goods had cost Awasu what 6.75 million. Okay, so it means that they have the 6.75 million in their inventory, isn't it? Okay,
Yeah.
let's come here. Awasu is what? Is the subsidiary, isn't it?
Yes, sir.
Okay. The cost of the item by the subsidiary will be what? Will be what for the parents?
So the question again.
I'm saying that the cost for the goods of the goods for the subsidiary will be what to the parents?
Will be the selling.
Will be the selling price, isn't it? Okay.
Yes, sir.
The question is, who is charging the profit? It is the parent, isn't it?
Yes, sir.
Okay. But we are giving what? Selling price, isn't it?
Yes, sir.
So what do we have to do? We cannot apply markup on what? On sales. We apply margin on what?
On sale.
Okay. So what do we
Yes,
have
sir.
to do? We have to change the markup to what?
Margin.
Okay. So we now come to, let me just use the question about, these are just examples. Okay. There are no questions. Okay. So we have the Takwa is the parent who is selling. Okay. So let's now look at the provision or the profit that are yet to be realized on that particular one. Okay. Markup to margin. Margin must always be lower than what? Markup, because margin will be applied on a selling price, which is higher than the cost price. At the end of the day, the two of them should be giving you what? The same profit. So
Yes, sir.
selling price is higher, so margin should be lower. Okay. Cost is lower than the what? Lower than the selling price. So markup should be higher, so that if you apply it, you'll be having the same result. So whatever you are going to be doing, is either you add the numerator to the denominator or you subtract. Okay. I cannot sing for you that if you are changing markup to this one, go and do it like this. And if care is not taken, you are forgotten in the exam and you go and do the opposite of it. Just know that margin will always be lower than what? Will always be lower than markup. So come here, you have 35. Okay, you have 35. So the question is, you either subtract the 35 or add the 35. So you just do it. If you are changing from markup to margin, margin should be lower. Then if I have 100 minus 35 now, no, if I multiply by 100, the answer that I'm going to be getting will be higher than what? Than the markup. But margin should be lower. So let me just add and see. So you just do your rough work over there by knowing that markup should always be higher than what? Than the margin. Okay. So I'm going to be having 35 over what? 135. Is that correct?
Yes, sir.
Okay.
Yeah.
So my provision for unrealized profits now will be 35 over 135 multiplied by 6,750. What are we having?
170.
57.
170.
Okay. So that will give us
Yeah.
1.75 million, isn't it?
Yes, sir.
Okay. So if you are doing this one, we are doing statement of financial position. That's why they haven't given us the total sales for the year. So what you do is that who is selling the goods? The parent, isn't it?
Yes.
So the parent is recognizing this portion of the profit in each retained earnings or in each profit that is yet to be recognized. So you go and debit the return or the group retained earnings. Okay, you go and debit the group retained earnings. Okay, you go and debit the group retained earnings of the 1.75 million. Okay. The corresponding entry will be what?
Inventory.
Okay, so we credit the inventory. The subsidiary will be carrying the inventory at selling price, which should be carried at what? At cost price. Unless the inventory is sold at a loss. Okay, sometimes they will tell you that this particular the inventory is sold at a loss. We don't make provision for what? For a loss. Okay. So let me also talk about that before we move on. Sometimes the sale can be made at a loss. Okay, sometimes the sale can be made at a loss. So let's come here that the parent is having the cost of the items, the cost of the, so let's say the cost is, 80,000. Okay, and this has been sold. The parent sold it at, okay, so the parent, this has been, okay, this has been sold at, let's say, 75,000. Okay, you can see that the goods has been sold at a loss, isn't it? The goods has been sold at a loss, isn't it?
Yes, sir.
Okay, this loss must be as a result of the goods is now obsolete. So there is an impairment of what? There is an impairment of, let's say, 5,000 there. Okay, the parent will be having a revenue of 75,000, and they will be having a cost of sales of what? Of
Okay.
80,000. Okay, let's assume that the subsidiary was able to sell only 7,000 out of this one. So the subsidiary will be having revenue of 70,000, and they'll be having cost of sales of 75,000 minus 5,000. I hope that is correct, isn't it? Okay. If we are grouping these two, this will now be 70,000 plus 70,000. Okay. You see that at the end of the day, the loss will still be 5,000, isn't it? Okay. These goods, the goods that has been sold to the subsidiary, the goods were not sold at profit. So we can't make provision, or there will not be a portion of the profit that is here to be realized. But what we are going to be doing over here is that we just remove the entire sales. So we remove 75,000 from this side, and we also remove 75,000 from this side. What are we going to be having? We will be having 70,000 over here, and we'll be having against what? 75,000. Is that correct?
Yes, sir.
Okay, we still have the loss of what?
5,000.
Okay, what I'm trying to say is that when they say the goods has been sold at a loss, the only entry that you are going to be doing is to remove the sales. That's all. We don't make provision for what. There's no profit element on the what? On the sale. So it's just a loss. Loss has to be recognized. Okay, so they can say the goods has been sold at a loss. The only entry that you are going to be doing is to remove the sales. Okay, there is no profit over there that you are going to be removing because the goods has been sold at a loss. So we only do the adjustment for a sale that is made at a profit, and that will always be the case for you, because this one you can see that we are not doing anything like that. Okay, you only remove the sales when the goods has been sold at a loss. We don't make provision for what? For a loss. Okay, we don't make provision for a loss. Okay, so let's come here. Let's come to this one. So this is what we are going to be doing for this one. Let's take the second one and see what we can do. Yeah, question number
Cratchit,
4. Yeah.
Cratchit, the subsidiary, sold goods to Ho, the parent, in 2011 for 8 million. Ho had included one half of these items in its year-end inventory. The items were bought by Cratchit for 10.5 million from an outside supplier. At year-end, Cratchit still owed the supplier 50% of the purchase cost. At year-end, Ho did not owe Cratchit in respect of the above transaction. All items were in good condition at the date of transfer. Ignore deferred tax implications.
Okay. So this is actually intra-group sales, but there is no issue of what? Of unrealized profit over here. Because the goods has been sold at what?
8 million.
Okay, but the cost of the item is what? 10.5, isn't it?
Yes, sir.
The goods has been sold at what? At a loss, isn't it?
Yes, sir.
Okay. But they are saying that the goods were in what?
Good condition.
So if the goods were in condition, what we do is that we only impair an inventory if the inventory is obsolete, if the selling price is now, if the selling price has reduced significantly, or there's no demand for that particular item again, or the goods has damaged. Okay. But you can see that the subsidiary is impairing the goods by what? By 2.5, isn't it?
Yes, sir.
Okay. This is what you are going to be doing. Okay. This is what you are going to be. The accounting for that particular one is different from what we are going to be doing here. Okay. The goods has been sold. The goods has been sold at a loss of what? 10 point. The goods has been sold at a loss of 2.5. Okay. So they are saying
2.5.
that they still have what? 50% of these goods in store, isn't it? One half. Okay. We still have one half of these goods in store. Okay. If you still have one half of these goods in store, it means that the parent will be keeping what? 4 million out of that, isn't it?
Yes, sir.
Okay. And the cost of that particular item will also be, so let's determine the remaining goods, the selling price of the remaining goods. Okay, the selling price of the remaining goods will be 1/2 multiplied by 8. Okay. And we are going to be having 4 million, isn't it? Okay. What will be the corresponding cost price of that? The cost price will be 1/2 multiplied by 10.5 million. Okay. That will give us what?
5.25.
Okay, 5.25. Okay. And the loss on this particular item will now be 1.25, isn't it?
Yes, it is.
Yes.
Okay. The half of the goods has been sold already, so we can't do anything about that particular loss. The loss has already been written off. But the ones that we have over here, they are saying that these goods are in a good condition, so there is no need for impairment. The goods are in good condition, so there is no need for measuring the goods at lower of cost or net realizable value. We only impair an item when there is what? When there is an indication for what? For an impairment. The goods are in what? In a good condition, we can the minimum amount that we can sell it is the what? Is a purchase price. There is no issue that we are going to be selling the goods lower than that particular amount. The goods are in good condition. So this is what we do. The time that the Kratchis sold the goods to these people, they have recognized a loss of what? A loss of 2.5. Okay. Now, the remaining goods are now in good condition. The remaining ones are there. The 1.25 loss is already what? The goods has been sold already. So that one, we can't do anything about it. It has been sold at that particular price, which is lower than that particular one. We don't have any issue with that. We can't do anything because it has been sold. But the remaining goods are now in good condition. So what we do is that the goods should be valued at cost, not what? The net realizable value, because there is no indication for impairment. So this is what we are going to be doing. The parent will be having 4 million in inventory. Okay. But we have to value the goods at what? At cost price, which is the what? Which is the minimum amount, because the goods are in good condition. There is no need for impairment. So this is what we are going to be doing. Okay. So we have 4 million. The parent will be having 4 million in what? In inventory. What we do over here is that we go and increase the inventory. We go and increase the inventory by 1.25. So we reverse the impairment on the goods that are yet to be sold, because the goods are in a good condition. There's no need for impairment. Then you now come here. The impairment of 1.25 has been taken from their profit. So you go there and do, okay, this will go to net assets because it is a subsidiary that is selling. So this will come to net asset at reporting. Okay. Because their retained earnings is that the profit for the year is under what? The net asset at reporting, which is included in the closing return earnings. So we go there and do this. It is a subsidiary that is selling. So they will reverse what portion of the loss that has been recognized. The goods should not be written down to what? To the net realizable value because they are in good condition. We only carry out impairments when there is what? When there is a condition or there is an indication to do so. They are saying that the goods are in a good condition and there's no need for what? For impairment. There's no need for impairment. This is a different side of the intra-group. There's no unrealized profit over here. We are only reversing portion of what? Of the impairment that was what? That was recognized. Okay. They say that Catches still owe 50% of the purchase cost. It means that they are still owing the what? They are still owing the supply. They have recognized this transaction already. That is none of our business. Okay, that is none of our business. There is no intra-group balances between them. If there's any intra-group balances, we cannot be owing one another. So we cancel that one and move on. Okay, let's take the last one. Then we look at transfer of PPE. Okay. Yeah, Senior Alessandra.
Sir,
Yeah.
so please, you're saying because it was a subsidiary that sold the goods, that is why net assets was credited.
Yes, please.
So if it was the parent, it would have been the group retained earnings.
Yes, please.
Okay.
All right. Sinavero, we are still together. Question number 7.
Okay. During the year end 30th June 2022, Mamponten, the subsidiary, made sales of 50 million to Jamase, the parent, at 25% above cost. 60% of these goods were sold by Jamase during the year. As at 30th June 2022, Mamponten has receivable with Jamase of 25 million.
Okay. So this is also intra-group what? Intra-group transaction. Okay. So they are saying that the sales has been made at what? 25 above cost. So 25% over here is what? Markup or margin? Markup or margin?
Markup.
Okay. It's above cost. Okay. It's above cost. So that is a markup. Okay. But the total sales that has been made is what? 50 million. So if you are doing your statement of profit or loss, you go and take 50 million from cost of sales, 50 million from revenue. Okay. But they were able to sell only what?
60%.
Okay. So it means that 40% of the goods has not been sold. By the time that they are selling, they have recognized their sell at 100%. So what is the profit element on what? On the 40% that is yet to be sold. So we come and calculate provision for. So if we are doing, assuming we are doing statement of profit or loss, we are doing statement of profit or loss. What we have over here is that debit revenue with a total amount of 50 million. Then we credit cost of sales of 50 million. Okay. So that's what we do if you are doing statement of profit or loss. Okay. Let's count to the provision for unrealized profits now. Okay. Provision for unrealized profits on the trading. Okay. That will give us 0.4 multiplied by 50 million. That is a portion of the goods that are yet to be sold, isn't it?
Yes, sir.
What is the profit element? What will be the margin there? Would that be 20%?
Yes, sir. 20%.
So that will be 0.2, which is the same as 1/5. I hope you are okay with the 1/5.
Yes, sir.
So what is the profit element on that?
4 million.
Yeah,
4.
4.
Okay. Okay. So we have 4 million. Okay. This 4 million is the unrealized profit. It's a profit that is here to be recognized, but the Mamponting has recognized the sale at 100%. So the profit of 4 million is in their profit. So if you are still doing statements of profit or loss, okay, this is what you do. You go and debit cost of sales, okay, with a 4 million. Then you credit what? Inventory. Okay, the inventory will be in the statement of financial position. Okay, let's come here. Assuming you are doing statement of financial position. Okay, what are we going to be debiting? Who is selling? Who is selling here? Who is the seller?
A subsidiary.
Okay, so where can we find the profit of the subsidiary?
Yeah. Assets schedule.
The net asset at reporting. So the retained earnings, the profit will be net asset at reporting. Okay, so you have net assets at reporting. So that will go and reduce that 4 million. Then we still credit the inventory with what? With 4 million. Okay, let's come to, there is something that we are saying over there, that Mampontin has receivable with what? Jamasi of 25 million. That is an intra-group balances. So Jamasi will be saying that they are owing Mampontin 25 million. Mampontin will also be saying that they are owing that particular people. No, it cannot happen. We cannot be owing one another as a group. Okay, so what we do is that we remove it. You go to receivables and you take away 25 million. You go to payables, you also take away 25 million. We look at that one in details where the difference will be a reconciliation between our cash or our inventory. Okay, let's come to the next one, which is a transfer of PPE. Okay, the transfer of PPE. Okay, please, it doesn't matter who is selling. Okay, if it is the parent that is selling or the subsidiary that is selling, the treatment is the same for the inventory. Okay, the treatment is the same. So we have the transfer of PPE. Okay, what do we call the transfer of PPE? Okay, transfer of PPE. Okay, these two is okay. So transfer of PPE. These are the popular ones that you are going to be saying. Okay, after the acquisition, the parent can transfer and use what? They can transfer what? A PPE or asset that they are not using. They will give it to the subsidiary to use now. Okay, or the subsidiary will give it to the parent to use. Any of them, the treatment is going to be the same, but just that the item is going to be which one? If it is the parent that is selling, it will affect the parent what? Figures. If it is a subsidiary, it will affect the subsidiary figures. Okay. So what is going to happen is that we always assume that the PP that they are transferring is carried at cost model. Okay. The PP that you are transferring is carried at cost model. Okay. Let's come here. If you have purchased, okay, let's say you have plants that you have purchased at 50,000. Okay. And the useful life is what? The useful life is 10 years. Okay. Okay. You have used this particular thing for 5 years and you are giving it to somebody. Okay. The person will now use it for the remaining 5 years, isn't it?
Yes, sir.
And this particular one, since the person is related to you, okay, since the person is related to you, or let's say you have a head office that you are using. Okay, it was purchased or it was contracted at what? Or it was constructed at a cost of 50 million, which will last for 10 years. You have used 5 years already. If a branch is coming to occupy that, the branch will now occupy the remaining 5 years at the remaining what value left, isn't it? It will now come and use the remaining value. Okay, it will now come and use the remaining value of the item for the remaining useful life. Okay, what we are trying to say is that the parent is still using the head office through the what? Through the branch, because the branch belongs to the head office. So there is no way the parent will be saying that they are selling the item to what? To the head office. No. But in their individual financial statement, they are going to be recognizing this as a sell. No, that cannot be possible. Okay, so what will happen is that if you are transferring the PPE, you are just using the PPE yourself, but you are not using it yourself. someone related to you or a branch or a head office relating to you is the one using it. So you are using the PPE through the what? Through the subsidiary or through the parents. So this cannot be done. The transfer cannot be done at what? At fair value because it is carried under cost model. So if you want to transfer to them, it should be transferred at what? At carrying value. They will use the asset for the remaining useful life. So if you have 10,000, you have 50,000, you have used 5 years, it means that remaining 25,000 will now be consumed by what? By the branch over 5 years. You cannot say you are giving this to them at what? 30,000. No. You cannot fair value before transferring. No. It is carried under cost model. So the transfer or the sale should be made to the group or to the subsidiary or to the parent at what? At the carrying value of the assets. Okay. So what is going to happen is that they will be giving you some situations like this, that the parent has sold a PP or a plant, or the parent has transferred a PP, or it can be sold or transferred to these people at a price of at a fair value of 30,000. Meanwhile, the parent is having what? 25,000. So they will give you a carrying value at the date of the transfer to. The transfer should be made at what? At carrying value, because you are giving the item to your what? To your own company to occupy. So they will occupy for the remaining useful life. You are still using the what? The assets through them. Okay. So what they will tell you is that they will say this has been made at the beginning of the year or middle of the year. Okay. The transfer should have been done at carrying value. The question is, if the transfer is done at carrying value, what would have been the depreciation? The depreciation would have been 25,000 divided by 5. Do you agree?
Yes, sir.
Okay. But the subsidiary charge what? What is the depreciation charged by the subsidiary? The subsidiary was charging a depreciation on the fair value of 30,000, isn't it?
Yes, sir.
Okay. So the depreciation will be how much? That will be 6,000, isn't it?
Yes, sir.
Okay. So what you have to do is this one. Okay. The parent cannot sell the parents cannot sell the PPE to what? To the subsidiary. Neither would the subsidiary sell the PPE to the parent. They will just give the item. It's just an idle item that they are not using. So they'll just give it to them to use for free. So there should not be any sale here. There should not be any transfer here. By the time that the parents sell this one, the parent is recognizing a profit on the sale of what? Profit on disposal of what? Would that be 5,000? Okay. The carrying value of the item is 25,000, but they say that they are selling to the subsidiary at 30,000. There will be a profit of what?
5,000.
Okay. This you cannot sell. You only give the item to them to use. Okay, it's an idle item that you are not using. So you want, okay, since we are not using it, it cannot be here. Let's give it to them to use. And you are now saying that you are selling to them at 30,000. No, there cannot be a sale. You cannot sell that particular item. So what you do over here is that you have to come and remove the sale. Okay, so whoever is selling, this particular profit will be in each retained earnings. So you come here and debit what? If it is statement of financial position, you debit the group retained earnings because that particular one has been included as profit. So you go and remove it. Okay. Then the subsidiary will be taking the asset at what? At 30,000. So you also go and reduce the asset to what? To only 25,000. So you go and credit the PP by 5,000. Okay, so it means that they are also keeping the PP. The subsidiary will be keeping the PP at 30,000. Let's go and remove that. Okay, the depreciation that should have been charged, okay, should have been 5,000, but the subsidiary has charged a depreciation of what?
6,000.
Okay, and this 6,000 has been taken from the PPE. The PPE will be shown as what? As carrying value. So our carrying value at the end of the year should have been 25,000 minus what? 5,000. That will give us 20,000, isn't it?
Yeah.
Yes, sir.
Okay. But the subsidiary is showing 30,000 minus what? 6,000, isn't it?
Yes.
Yes,
And that will give us 24,000 now, isn't it? Okay.
yes, sir.
that 24,000, you can see that we are coming to subtract what? 5,000 as making, so we are reducing this 30,000 now to what? To 25,000. And the depreciation that should be taken is what? 5,000, but we are now taking 6,000. So we have to now reduce this particular figure by adding what?
1,000.
By adding 1,000. Okay. If we take 5,000 from this will be 25,000. This will now be 25,000 minus what? 6,000. That will be 19,000. But the carrying value should be what? Should be 20,000. So the 5,000 over here is coming with excess depreciation of 1,000. So since we are taking the 5,000, the excess depreciation should also be removed, which is part of this one. So this is the first entry. The second entry is, this is what we are going to be doing. We calculate the excess depreciation that the subsidiary or the parent is charging as a result of the transfer. Okay. The subsidiary has what? Has overcharged their depreciation by 1,000. What will be the effect of that on our profits? It will reduce our profit, isn't it?
Yes, sir.
So we
Yes.
go and increase the profit. So what you do over here is that you debit the PPE to neutralize the effect of what? Of the 5,000. Then you come and
Earnings.
credit their net assets, because this is it's the subsidiary that is selling. If it's the parent, that will go to the group return. It is a subsidiary that is buying, so that will be net asset at reporting. This will be affecting the profit, and the profit will be at reporting. So we now have the 1,000 here as the figure. So this is how we go about this one. This one is just like the cell over here is just like what? It's just like upwards revaluation of a PPE. Upwards revaluation of PPE. The treatment is just like, I say upwards, downwards revaluation of PPE. Downwards revaluation of PPE. If the PPE is revalued downwards, the subsidiary will be charging depreciation on the original amount. They will be overcharging. So the treatment is just like this one. So there will be a transfer of PPE. You should be able to take note of that. There will be a transfer of PPE. You should be able to take note of that. Okay. What do I want to say again? Okay, let me use this question to explain.
Sir,
Yes, please.
so will you be wrong? Will you be wrong if you credit retained earnings?
For which one? The parents?
No, the one that you just did. If you can flip back to.
Or if you go to return earnings, the return earnings of the subsidiary is included in the net assets. So if you put the return earnings over here, you just have to know where the return earnings is. Okay. So the return earnings will be under the net asset. That's why we are making it net asset.
Okay.
The
Okay.
return earnings will be part of the net assets. So that's why we are doing it at net assets. Okay. So let me. Okay. Veron, can you pay the 8 for us?
Okay. On 1st January 2022, Mompontin, the subsidiary, sold the machine to Jamasi, the parent, for 55 million at a gain of 10 million Ghana cedis. The remaining useful life of the machine at the time of disposal was 5 years.
Okay. So let's assume that the reporting year is January to December, isn't it? Okay.
Yes, sir.
And they are saying that the machine has been sold at how much?
55 million,
And the gain is what?
10 million,
So what will be the carrying value of the machine?
55.
Okay. The carrying value will be 45, isn't it?
Yes.
Yeah.
Okay. So we have question number 8, which is the 1.10. Okay. So let's come here. So what do we have to do? There should not be a sell, isn't it? So we have to reverse what? The gain, isn't it?
Yeah.
Okay, who is selling? It's a subsidiary, isn't it?
Yes, sir.
Okay, so that particular 10 million is included in their net assets. So net assets at reporting, we go and now what? And now remove the 10 million. Okay, that 10 million should be removed. The parents will be carrying the what? The PP at 55 million in their books, isn't it? Which should be 45 million. So we go there and remove that thing from their PPE. Okay, so we go and remove the 10 million from the PPE. Okay, let's come to the issue of depreciation. Okay, what is the depreciation charged by the parents? The depreciation charged by the parents would have been 55 million divided by 5. Is that correct?
Yes, sir.
The depreciation charged by the parents is what? Is 55
11 million.
million, okay, divided by 5 years, which is the remaining useful life. So they will charge the depreciation based on the total amount that they have paid for the asset. Okay, that will be 55 million. Okay, why are we not adjusting the cash? If you adjust the cash, you still be having the same answer. The cash of the parent will reduce by 10 million, and the cash of the subsidiary will increase by 10 million. It's going to be having a zero effect because we are reversing the transaction. Okay, so there should not be any gain on that. Okay, but since we have reversed the 10 million now, it means that the depreciation should have been what? On 45 million, isn't it?
Yes, sir.
Okay. So the depreciation should have been on 45 million. So 45 over 5, that will give us what?
9 million.
9 million. So we have charged a depreciation of 11 million instead of what? 9 million. Okay.
Million, yes.
So the parent has taken a depreciation of 11 million to its retained earnings instead of 9 million. Okay, so what you do over here is that you go and debit your PPE, okay, of 2 million, isn't it?
Yes, sir.
And you credit the group retained earnings because the parent is the one charging the over depreciation. So that will be 2 million. Okay. You can also calculate the excess depreciation like this. Okay. The depreciation, you can see that the depreciation should have been charged on 45 million, but it has been charged on 55. So we have charged depreciation on excess of what? 5 years on 10 million. So you can just have your gain over here divided by 5. That will give you 2. So sometimes you might not be giving the carrying value, but you only be giving the gain. So the gain will be coming with what? With excess depreciation of 2 million. Then you just adjust this one. Okay. Sometimes the useful life might be different. Let's come here. The useful life might be different. The parent will now be saying that the useful life of the asset is now 6 years for them. I want to make it 8 years so that we can get exact figure. So 5 divided by 8, 5 divided by 4. Okay, let me just get it. Okay, 55 divided by 7. Okay, let me make it 55 divided by 8. 55 divided by 8. Okay, so let me just come here. Okay, the question can tell you that the remaining useful life of the asset at the date of sale. Okay, they can say the remaining useful life of the asset at the date of sale was 4 years. Okay, but the parent is now using a remaining useful life of what? So sometimes the useful life can change. So they will say the parent is now using a useful life of 5 years, or the parent has charged a depreciation based on what? Based on 5 years. This is going to be a 2 different issues. Okay, we are removing the asset by 10 million. Okay, if you remove the asset by 10 million, your depreciation will now be 45 million divided by the remaining useful life at that date, which is 4. What are we having? The remaining useful life of the asset at the time of the transfer was actually 4. What are we going to be having?
11.25.
Okay, 11.25. But the parent has depreciated the asset based on 5 years, isn't it? Okay, so that would be 55 divided by what? 5. That will give us 11, isn't it?
Yes, sir.
Okay, what is happening here? Are we overcharging or we are undercharging the depreciation?
Overcharging the depreciation by 0.25.
No. This is the depreciation charged by the parents. The parent charged the depreciation on what?
Then we are undercharged.
We are undercharged, isn't it? This one, the treatment will be different. Okay, so what you do is that the parents, you are going to be what? You are going to remove the 10 million. The gain should be removed. But if you count the depreciation, they are not using the same what? They are not using the same useful life to charge. But you ask yourself, if the asset has been given to them on carrying value, or if the asset has just been transferred to them to use, they will use it for only 4 years. So the depreciation will be 11.25. Okay. But they are now saying that this is what they have done in their books. They are going to be charging the depreciation on the amount that they have bought it. And that will be for 5 years. So they have done 55 over this one. So this is the depreciation in their what? In their books. Okay. It means that the depreciation that should have been charged should have been 11.25, but they are charging 11. So we come here and debit the group retained earnings. Okay. It means that we still have to charge a depreciation of 0.25 million. Okay. Then you come here, you have to go and credit the asset again because they have subtracted 11 million instead of 11.25. So we go and have your PPE as 0.25 million. Okay. This one normally happens for corporate reporting people where the transfer will be done. You have to go and reverse it, but the useful life are going to be different. The useful life are going to be different. So you have to calculate the depreciation now and determine whether they are undercharging or overcharging. Then you pass the entries for that particular area also. That particular area also. Okay. Let's come to the next one is what? What is the next item that I've written there? Okay. The next item. Okay, let's come here. Okay.
The financial liability.
Okay. What is going to be happening over here is that the asset is assumed to be carried at cost model. I've said that already. What if the asset is carried at what? As revaluation model. What if the asset has been carried at revaluation model? It means that the asset should be transferred at fair value, isn't it?
Yes, sir.
Okay, so with revaluation model, there is no entry that you are going to be passing because all the things that have been done by them are correct. The parents or the subsidiary will first of all revalue the asset to fair value before they will transfer. So they will have a revaluation gain over there. Okay, so what we are going to be doing is that we remove the profit on disposal and go and send it to what? Revaluation reserves. The asset will be given to the subsidiary or the parent at fair value, and the depreciation will be done on the revised amount now. So if you are revaluing, it means that the useful life has also been revalued. So if it is carried under revaluation model, there's no entry because they have to revalue and transfer. And the depreciation must be charged on a new revalue over the remaining useful life if the useful life has not changed. But if the useful life has changed, then depreciation will now be done on the revalued amount over the remaining useful life of the assets. But what is going to happen is that if it is done at the revaluation model, no entry will be passed there, and they are going to be making the work very simple for you. So any transfer over there will be assumed to be carried at what? At cost model. The asset will be assumed to be carried under the default method, which is the cost model, unless otherwise what indicated by what? By the examiner. Okay, let's come here. Let's come here. We have investment in financial liabilities. So investments in financial liabilities. So we are going to be looking at two. Investments in financial liabilities. We are going to be looking at, okay, we are going to be looking at investment in preference shares. Okay, investment in preference shares.
The reflection of the quality of your thinking. Sure. Oh. Life is a thinking.
Investments in preference shares and investments in loan or in loan notes. Okay, investment in loan notes. Okay. What we are saying over here is that after acquiring the equity shares of the subsidiary, what will happen is that the parent will buy preference shares in addition. Okay. After we have acquired a subsidiary, we are going to assume their liabilities. Is that correct? If you have acquired 100% of a company, it means that liabilities will now become your liabilities, isn't it?
Yes, sir.
Okay.
Yes, sir.
If you are now buying the preference shares, what does it mean? If you're now investing in the preference shares, what does it mean? Let's come here. Let's assume that you have acquired 100% of the shareholding. It means that the assets and the liabilities of that particular company will now become yours. You now assume the liabilities. Okay. So let's say the entity is having a preference shares of, okay, a preference shares of what? Of let's say 100,000 Ghana cedis. Okay. And you have now purchased 50% of that. Are you buying or you are paying the what? Your creditors back?
You are paying your creditors back.
You are paying them, isn't it?
Yes, please.
So what will happen over here is that the parent and the subsidiary, in their separate financial statements, the parent will be classifying the preference shares as what? As a financial asset. And the subsidiary will still be having the what? That particular amount over there. Okay. You are just buying, the buying is, the subsidiary is not issuing preference shares that you are buying. You are buying 50% of its existing shares. Okay. If you are buying it, it means that you are giving the money to the existing shareholders, existing preference shareholders. No. After you have acquired a subsidiary, their liabilities now become your liability. So if you are buying that from the existing shares, the existing preference shareholders, it's not that you are buying, you are paying your debt back because that is your own debt. So you are paying your own debt back. That is not what, that is not investment. But in their separate financial statement, what is going to happen is that the parents will be having that as a financial asset. Okay, the parents will be having that as a financial asset, and the subsidiary will be having that in their loan notes or in their preference what? Preference shares. Okay. What we have to do is that, okay, you are not doing investment in your what? In your own what? In the preference shares. You are paying those people back. So at the group level, this has to be eliminated. But in their separate financial statement, they are going to be accounting for this separately. But the liabilities of the subsidiaries now is not your liability. So if you are buying part of their preference shares, it means that you are paying the what? The people that you are owing. So what will happen is that you come here and remove the what? So this will be financial liabilities over here. You remove 50,000 over here because you can't, that is not an asset for you. You are just paying the people back. So you remove that. Let's come here. You'll be having 100,000 here. Then you come and subtract the 50,000 as a payment that has been made by the parent. So the subsidiary will now be owing what? 50,000 to what? To the preference shareholder because the parent has paid 50,000 part of the what? The debt. Okay. So we come here and remove it from there, wherever the parent is keeping the preference shares, and we also take that from the preference shares of the subsidiary. What if dividend has been paid during the year? What if dividend has been paid during the year? Okay. In the first place, the parent is supposed not to receive the dividends at all because you are just paying back your own debt. So there's no way dividends will be paid and you receive it. So if the dividend is being paid, the parent will receive the dividends and take it to their group retained earnings. And the subsidiary, since we don't know which type of preference shares is it can be redeemable or irredeemable. If it is redeemable, the subsidiary will be treating this as a finance cost. So what we have to do is that the dividend payment or the dividend declared, the entry for the dividend must also be reversed. So if you are reversing that, if you are doing statement of financial position, you debit your group retained earnings. Okay, you debit the group retained earnings with the dividend payments. Okay, if there's any dividends, you debit that with the dividends received or the dividend declared, which has been recorded. Then you come here and what? Credit the net asset of the subsidiary because the dividends that has been declared or paid will be taken away from their profits. So you have to go and reverse it back. Okay, so we have the net assets as reporting here. Then you remove the dividends. Okay, but if you are doing statements of profit or loss, maybe the parent might be having the dividends in investment income. So what you do is you go and debit the investment income by removing the dividends over there, debit investment, the investment income, okay, with that particular one. Then you credit the finance cost, whatever the parent, whatever the subsidiary is putting this particular dividend. If it is redeemable, they will be treating it as a finance cost. So you go and remove it from the finance cost. Okay, this is how we go about it. The same treatment for loan notes. So what we do is that the loan notes, after buying the what, after acquiring the subsidiary, all the liabilities will now be assumed by the parent. So the liabilities of the subsidiary are the liabilities of the parents. So if you are buying part of the loan note, okay, if you are buying part of the loan note or you are investing in the loan note, it means that you are paying part of your liabilities. So wherever the parent is having a loan note, you go and remove it from the financial asset or wherever they are putting it as an asset. You go and remove the amount that they are paying and you remove it from the loan note. If there's any interest that has been paid and it has been received by the parent, the entry will still be the same thing like this. And the entry will still be the same thing like this. Okay. But what if the parent has now what? The subsidiary is issuing new loan notes now, and the parent has acquired it. Okay. The treatment will still be the same because the loan note will now be added to the existing loan note of the subsidiary. And the parent will be classifying that one as financial asset or whatever. You go and you reverse everything that has been done. You reverse everything that has been what? That has been done. Okay. Let's come to intra-group balances. Intra-group balances. I'm sure this should be the last one for now. Then I will just talk about how to approach the exam. I'm not sure we can solve a question today, but don't worry. We solve question and we see what will happen. So let's come to intra-group balances. Okay. Intra-group balances, we are basically going to be talking about intra-group balances. We are basically going to be talking about issue of receivables and payables, where the parent will be saying that they are owing the subsidiary this amount. The subsidiary will also be saying that the parent is owing them this amount. Okay, you cannot be owing one another. Okay, so we are the same entity. So if we are coming together, why will you be saying, I cannot owe you, you cannot owe me? So what we do is that we go and remove those ones. So the question will be telling that the one that we say over there, they are saying that Mampontin is having a receivables of 25 million from what? From the parents. So the parent will also be having a corresponding payables of 25 million. What we do is that we go and debit the payables by removing it. We go and remove, okay, 25 million from payables. Then you credit the receivables by also removing what? Also removing the 25 million there. Okay. Sometimes the question can tell you that there has been a reconciliation and the current account. Sometimes they will use current accounts. Okay. The current account of the subsidiary differ from what? Differ from the parent as a result of what? Cash in transit, as a result of payment that has been made to this person, but they are here to receive that. Or as a result of goods that have been dispatched to this person and they are here to. So it can be the difference. Sometimes there can be a difference over here. The difference can be caused by what we call cash in transit. Okay. The difference can be caused by what we call cash in transit or goods in transit. Okay. Or goods in what? Transit. Okay. I will explain that. Okay. So let's come here. We do a reconciliation. Okay. At the end of the day, everything have to be reconciled. Okay. Between the parent and everything. So we have to do a reconciliation, goods in transit. Okay, let's come here. So let's use this example now. They consider the subsidiary is having a receivables of 25 million, but the parent is having payables of what? Of 20 million. What is the difference? The difference is what? 5 million. Okay. Okay, this 5 million, what they will say is that the 5 million is as a result of a check that has been signed and sent to the subsidiary, but that check was received after the reporting date, or they will say the check has been received after a particular, or the check is here to be received. What we do is that we assume that the check has been received at the reporting date. So this is what you are going to be doing. So if the subsidiary has received a check, it means that the receivables will be reducing by what? 5 million, isn't it? And cash or bank will be increasing by 5 million, isn't it? Okay.
Yes, sir.
So this is what we do. We debit our payables by reducing. So we debit the payables by reducing it by 20 million. Then we debit cash or bank. Okay. So the 5 million will be received by the cash or bank. Then we now credit the receivables with an amount of what? 25 million. Okay. So what you do is that you can pass entry for the receivables. If you receive the 5 million, cash will be increasing, receivables will now be what? Will now be reducing. So receivables will now be the same as the payables. Then you will now remove. Okay. Another way is that just go and take all the 25 million from the receivables. Then cash will increase by 5. Then payables will be reducing by 20. At the end of the day, the asset will be reducing by 20. The liability will also be reducing by 20. You will be having the same figure. Okay. Sometimes they can also tell you that this particular one over here is as a result of goods in transit, and the goods will be transported at selling price. So the goods that are here to be received by that particular person is none of them has been sold, but the person transferring this has recognized the goods as a sale. So the profit over there must be removed. So there will be a provision for unrealized profit on that. Okay. And we have to remove that particular one. Okay. So let's come here. Let's assume that they are saying that the 5 million over here are goods that has been dispatched by what? Goods that has been dispatched by the subsidiary to the parent, but the subsidiary is here to receive these goods. The question will tell you that you should do the what? The intra-group reconciliation, assuming that the goods has been received, even if they haven't said that you have to do the reconciliation. Okay. So this is what will happen. Okay. So since those people are here to receive their goods, you can do this entry in 2 ways. Since they are here to receive their goods, they haven't received their goods. So the parents will assume that their sales has not been made at all. The sales has not been made at all. So what we do over here is that we have to reverse the sales. So we have to reverse the sales. How do we reverse the sales now? Okay. The question will be telling you that the sale is made at a profit of 1 million. Let's use 1 million as a profit. Okay. The profit is 1 million. Okay. So what will happen is that the time that the goods has been sold, the entity has debited receivables. The entity has debited receivables of 5 million, and they have credit revenue of 5 million. Okay. The same way, they have also debited cost of sales of 4 million, because the profit element on this is what? Is 1 million. And they have also credited what? They have credited inventory, because the goods will not be there again. So the inventory has been credited by 4 million. Okay. What we are saying over here is that the goods has not been received by these people. So what we have to do over here is that we have to reverse what? We have to reverse the transaction. Reversing the transaction means that we have to now assume that the inventories are still with us. So the inventory, we haven't sold it, the inventory will still be with us. So we now debit our inventory by 4 million. So it means that that inventory should not be removed. Okay. This is what we are going to be doing. Okay. What is the profit element on this? Okay. Let me do this one like this. Let me do this one like this. So we debit what? We debit the revenue. The revenue was credited. So we debit the revenue by what? By 5 million. Okay. Receivables was what? Receivables was debited. So we credit the receivables by reversing this. Okay. And that will give us 5 million. Cost of sales was debited. We debit cost of sales by what? By 4 million.
1 million.
Okay. Let's come here. You can see that between revenue and cost of sales, what is the difference there?
1 million.
Okay. So what we can do over here is that we can actually come here and take these ones. The person who is selling, if it is a subsidiary, will go and what? And debit their net asset with 1 million, which is a profit element. Okay. In effect, this is the entry that you are going to be passing. So profit element of 1 million has been recognized. Go and remove it. Okay. So if this is what they are saying, that the goods has not been received, it means that you reverse the transaction. So you go and take 5 million from receivables. Taking the 5 million from receivables now will make it 20 million against 20 million. So you can now what? You can now subtract 20 million, 20 million. Okay. But if you count to the inventory, you now add 4 million to the inventory because the goods has not been sold. So we still have the inventory with us. The profit that has been recognized by the seller will also be removed. Okay. The question can also tell you that perform the reconciliation assuming that the goods has been received by the buyer at the date of what? Reporting. In this case, this is what you are going to be doing. So you'll be the entry over here, you have debited receivables. So if the goods has been received by the buyer, they are going to be debiting their inventory. Is that correct? They are going to be debiting their inventory by 5 million, and they are going to be crediting their payables by what?
5 million.
By 5 million. Okay. But the issue is, has any of these items been sold? None of the items have been sold, isn't it?
Mhm.
None of the items have been sold. So it means that the profit of 1 million supposed not to be recognized. So this is what you are going to be doing now. This is what you are going to be doing now. So you come here and what? Debit inventory of, I say debit inventory, debit the net asset, whoever is selling. If it is the parent that is selling, to be debit the group return earnings. So debit the net assets or the group return earnings. So let me just look at the two. By 1 million, which is a profit on the goods that are yet to be sold. The goods has not been sold, so you can't recognize profit. So whoever recognize the sale of 5 million and cost of sales of this one, there's a profit of 1 million. That profit is here to be realized. The goods are here to be sold. So that particular profit will be gone off or will have to be taken off. Okay. But the inventory, the person will now be recognizing inventory at what? At 5 million. The inventory should be measured at lower, of course, on net realizable value. So we have to come and make it 4 million now by crediting our inventory. Okay, by 1 million to make it 4 million. So if they are telling you that you should assume that the reconciliation is done as if the goods has been received, that means that you pass the entries for what? For this person. So the person will now, the inventory of the person will now be increasing and the payables will also be increasing. So you go to the statement of financial position, you add 5 million to their payables, you add 5 million to their inventory. So the payables will now be 25. So plus 5, that will be 25, 25. Then that will now be equal. So you subtract them now. Okay. Then you come to the goods. There's a profit element of 1 million. The goods are here to be sold. So what you do is that the profit element has to be removed and the item should be recognized at cost because the goods are still with the parents. The subsidiary is part of the parent. So we pass this particular entry and we are good to go. So that can also, let me see if I have example over here. Okay, question number 6. I'm sure that the example 6 will actually, okay.
Premier had
All right, sit down.
okay. Premier had a trade payable balance owing to soccer of $350,000 as at 30th September 2010. This did not agree with the corresponding receivable in soccer's book due to 130,000 payments made to soccer, which soccer had not yet recorded.
Okay. So who is making a payment over here? Premier, isn't it?
Premier, yes, sir.
Okay. And they are saying that Premier has what? Their payable is 350,000.
Yes, sir.
Okay. And they say that they have made the payables that they are having now at the reporting days 350,000. They are saying that this did not agree with the corresponding receivable in soccer's book due to 130,000 payment made to what? Made to soccer. So the question now is what will be the receivables in the books of soccer?
480.
That will be
480,000.
that will be 480,000. Okay. So it means that the payables was initially 480,000 and they have made a payment of 130. And that is why they are now having 350. But soccer has not reduced its receivables by the 130. Okay. What you do over here is that it's a payment that has been made. So you assume that the payment has been received or the payment has not been made at all. Okay. If the payment has not been made at all, this is what you are going to be doing. Very simple one. So the time that the payment has been made, the premier is debiting payables of what? 130,000, isn't it? And they have credits, cash or bank with 130, isn't it? Is that the entry that has been passed for premier?
Sir,
Yes, please.
please, can you take it again? I don't understand that.
Okay. I'm saying that the time that the premier made the premier made the payment, the entry that they passed was they reduced their what? They are making payment in respect of payables. So the payables will be reducing. In that case, they are debiting the payables by 130,000 and they are going to be
So credit
crediting
their
cash
bank or cash.
or by 130,000, isn't it?
Yes, sir.
Okay. Let's assume that the payment has not been made. You can do this from two perspectives. You assume that the payment has been received by soccer at that date, or the payment has not been made at all. If the payment has not been made at all, it means that we have to reverse this particular transaction, isn't it? If the
Sir,
payment
Yes,
has
sir.
not,
sir, in whose books are we recording this? Is it
The
Premier
one
or Soccer?
paying.
the one that is paying, which is the premium.
I said the payable balance is 350,000.
That is the balance that they have after paying 130 million.
Oh, okay.
So the time that they paid the 130 million, the entry that has been done was they debited their payables by 130 and they now have 350. And they also credit their cash or bank by 130. But they are saying that this amount has not been received by what? By soccer. So we assume that this particular payment has not been made. So we reverse it. Reversing it means that we go and now add the 130 back to our payable, and we now come and add the 130 back to our cash or bank. So we assume that the payment has not been made. So we go to the payables for these people, add 130, you add 130 to the bank. So you now have 480 against what? 480. So you can now confidently remove 480 from receivables and 480 from what? From the payables also. That is one side of it. Okay. Now, another side is that you can assume that the amount has been received by soccer at the date of what? At the reporting date. If the amount has been received by soccer, it means that Premier will still be having 350 because they have paid. Okay. But the soccer will now be having a receivables of what? 350 now. So their 480 receivables will now be reducing by 130, and they are going to be having cash or bank increasing by 130. Okay. So receivables will reduce by 130 because they have received the payment. So their cash will be increasing by 130. Then they will also now have the 350 against the 350 over here. So you can confidently remove the 350 from payables and the 350 from what? From the receivables also. Okay, so you can use the two. Either the payment has not been made at all, or the payment has been received by the what? By soccer at the transaction or at the reporting date. If the payment has been received, what would that be the entries that soccer will be making? They will be debiting their cash or bank. They will be crediting their receivables by 130. So the receivables will now reduce to 350. So 350 against 350, we can now remove the payables and also the receivables of 350. Any of them that you are going to be using will be taken for, okay. So that is the group one. Okay, I'm not sure I have any other thing to talk about as far as the intra-group transaction is concerned. Okay, so what I will be talking about is that how do you approach this? How do you approach the question in the exam hall? Okay, So we'll be looking at the statement. Let me talk about investment in associates first. Okay. So let's come to investment in associates. Okay, how do we account for investment in associates? Associate is that particular person that you have what? You have a significant influence over. That is 20%. You have a shareholding of 20% in their equity shares up to, let's say, 20%, but less than 50%. How do we account for this? We use the IAS what? 28. So we use what we call the equity accounting method. Okay, what do we do? The equity accounting method, what we do is that it's just like you are putting money in a bank. If you are putting money in a bank, what will happen? You'll be having that particular amount of money in the bank as a deposit, isn't it?
Yes, sir.
Okay, and that will be an asset to you, isn't it?
Yes, sir.
Okay,
Yes.
what if you incur any cost in putting the money over there? That particular cost will be capitalized. So any cost, any acquisition cost relating to investment in assets, whether it's a transaction cost, whether it's a professional fee, whether it's a issue of own security, for that one is what is capitalized. It's only under subsidiary that the only cost that will be capitalized is what is the transaction cost or the cost of issuing own security. But if you come to investment in associate, any related cost relating to the acquisition, okay, any cost, either professional fee, any other cost, will be capitalized. So you add your transaction cost over here. Okay, you add your transaction cost over here. Let's say the transaction cost is this one. So any other cost will be what will be capitalized. Let's assume that the bank has now declared or that you have earned interest. Let's say that you have deposited. Okay, you have deposited 20,000. Okay, the bank has now what? You have now earned interest of what? 5,000 on a deposit. How much will be the total amount in the bank, in the account now?
25,000.
Okay. Let's assume that you have gone there to take 2,000 of the interest. Okay, the bank has given you the 2,000 of the interest as cash. How much are you going to be having in the account now?
23.
23,000.
Okay. So it means that the 2,000 will now be taken away. You will be having 23,000. Okay. The 23,000 that you are having over here, they are paying the 2,000 out of the interest, which is 5,000. Okay. So what you do over here is that if you come here, you have the share of the associate what? Profit. Okay. Share of the associate profit. That will be there. Then sometimes you have the associate will pay a dividend and you are going to be receiving a dividend. The dividend is paid out of the profit. It's just like you have earned interest of 5,000 and they are now paying you cash of 2,000 of the 5,000. It means that you have taken 2,000 out of it. You will be left with 3,000 of the interest. So the dividend is going to be paid out of profit. But the profit that you have over here, which is a share of the associate profit, is actually the profit before the dividend. So the share of the dividend is already included over here. Okay. It is the profit that has been made for the year that they are sharing into two parts for you. Okay. You are going to be taking one in the form of dividends, and you are going to be taking one in the form of profit itself, which you are not going to be receiving cash. So the profit that has been made for the year is 5,000, which is the interest. But the interest, you are keeping 3,000, but you are receiving 2,000 as cash. It is the same 5,000 that they are giving to you like this. This is the 3,000 after taking your interest. This is the interest that you are taking. So the total amount that you're supposed to be taking is 5,000. But you have already added the 5,000. But you have taken 2,000 out of that. That 2,000 is paid out of the interest. So it means that since you are taking 2,000 from the account, you are going to be having 3,000 of the interest left. So you'll be having 3,000 of the profit left. So you'll be taking share of the associate profit, share of dividends rather, and this share of dividends will be what? Will be a reduction. Okay, so they'll give you a share of dividends. The profit that you should be taking is what? Is share of the profit after dividend, not share of profit before dividends. Okay, so what you do is that the profit that you are going to be taking, they have given you part of it in cash and part of it in what? Not in cash. So that if you put the two together, dividend is paid out of profit. All right. Dividend is paid out of profit. So if they are giving part of the dividend to you, it means that they are giving the part of the profit to you in cash. Which portion that you are not receiving? That should be the one that will be added, because you have already received part of it now. It will not be part of, because they have paid. They have paid part of the amount that they are owing you. So they cannot be owing you again. You take the dividend out of that. There will be some times that there will be a share of the provision for unrealized profit by the associate. Okay, whether it is the parent that is selling to the associate or the subsidiary, the treatment is the same. Sometimes the parent can sell to the subsidiary, can sell to the associate, okay, at 20 million. Okay, the associate is here to sell 8 million of this, okay, but the parent is having, let's say, only 25% of it. Okay, so we find the portion of the unrealized profits, and the parent will take 25% of that because the parent is related to them. So if it should be a subsidiary, it means that they haven't sold all of them, but we are having only 25% of you. So what is the share of the profit? We take our only share of the provision for unrealized profits. Okay, then let's come to, there can also be share of revaluation reserve. Okay, share of revaluation reserve, or whatever is the case. Okay, so this can also be share revaluation reserve or loss. There can also be impairment of the investment in associates. So the impairment will be a reduction. Sometimes the question will tell you that, okay, the investment in associate has impaired by this. That one is only the parent investment that is impairing. We have an impairment that will be relating to the associate as a whole, and the impairment relating to the what? To the investment in the associate only. Okay, we take only the impairment relating to the associate only to this particular side. Then if we have this, you will now go and report this as an asset, which we call investment in associates under this particular one. How do you tackle examination question? If you are doing either statement of profit or loss, so let's take the statement of financial position first. The first thing that they are going to be asking you is to show how you are preparing the what? You are preparing the financial statement. How? Show the group structure. So you are saying that, okay, the consolidated financial statement, the parent is having 70% of the subsidiary, and NCI is having what? 20%. So you show the group structure as the first one. Whether you are preparing statement of financial position or profit or loss, group structure is very important. The second one is you show your net assets, which me, I don't show. I do my net asset calculation at acquisition in the what? In the calculation of the goodwill. And my profit, my post-acquisition profit, I will just take the profit for the year. Then I will adjust it by post-acquisition items, and I will get that one. But the best way to do it is to do the net asset. The net asset, you do acquisition and reporting. Acquisition will tell you the fair value of the company at the date of acquisition, which you are going to be using to calculate what? To calculate goodwill. At reporting, you are doing that reporting because you want to know the share or the profit that has been made by the subsidiary for the year, which will be shared. Okay, the profit which will be shared among the NCI and then the parent. So you show the net asset table at acquisition, at reporting. You also have to reconcile the investment in associates and also the equity items. So if you do this, you'll be having goodwill. So you calculate goodwill, or you calculate gain on bargain purchase. If it's a gain on bargain purchase, the gain will be recognized in retained earnings. Okay. Then you come to, let's say, these are the 5 major ones that you are going to be doing. You come to the NCI. So the NCI at acquisition, you'll be having the NCI at acquisition. What is the value of the portion that the parent is not buying? Okay, what is the value of the portion that the parent is not buying? Or what are we trying to see? The total value of the entity is 20,000. Okay, NCI portion is 3,000. So it means that the parent is acquiring only 17,000. This 17,000 will be matched against the amount that the parent is paying. This 17,000 will be matched against the amount that the parent is paying. Okay, this 17,000 will match against the amount that the parent is paying, and that these two will now be removed, and the difference will be, so if the parent is paying 19,000 for this, okay, we remove 17,000 of the subsidiary equity shares, and we also remove 17,000 of the investment. So the remaining 2,000 will now be what we call the goodwill. Okay, but we have to remove all the 20,000, but remove all the 17,000. It means that 3,000 will now be remaining, which we call the NCI. So we look at the NCI at acquisition, the profit that the parent is going to be making, the profit that the NCI, the subsidiary is going to be making, the profit is for the owners of the company, which the parents will be taking, let's say 70%, NCI will be taking 30%. In effect, the NCI is accounted for as investments in associates. Okay, because the NCI, they are only having significant influence. So in effect, we account for the NCI as what? Investment in associates. So the profit will be added there. Any impairment or any other issue, any share of revaluation reserve, any other issue will also come there. We pick a question, then we know what we are talking about. Okay. Then the next item will be the group retained earnings. So the group retained earnings will be the retained earnings of what? Of the parent entity itself. Then the other ones, you can do other workings also. You can do other workings for there can be provision for unrealized profits, there can be excess depreciation issue, then we have other issues. But this should be the major items, or let's say group revaluation reserves. Okay, there can be a revaluation reserve, and we do that for the group as a whole. Okay, you have a group revaluation reserve. Okay, that is that one. If you come to statement of profit or loss, okay, if you come to statement of profit or loss, we can also do statement of changes in equity. That is group one. We are going to be, that is not a big deal. If you come to statement of profit or loss, okay, group structure is very important. Okay, group structure is very important. Please, no net assets. Okay, because if they ask you for calculation of goodwill, you use the net asset at acquisition. Reporting is not necessary because we do the reporting to get the profit. You are preparing statement of profit or loss, which will give you the profit already. So why will you be doing net asset at acquisition and reporting? The only one that will be needed is what? Is acquisition. That is if you have been asked to calculate goodwill, or if you have been given information on impairment of goodwill, which you don't know. They have given you that the goodwill has impaired by 20%. So before you know the impairment, you have to calculate the goodwill before you know the impairment loss. But if you have given impairment of 2 million, there's no way you should calculate goodwill again, because they are not asking you to calculate goodwill. They are only telling you that the goodwill has impaired by 2 million, which they have given you the 2 million. You know the impairment already. But if they are asking you to calculate goodwill, specifically, then we come to the goodwill calculation. Okay, so if you come to the question is asking you specifically to calculate goodwill, then you come to goodwill calculation, or they have given you a percentage for impairment, which you don't know the goodwill, so you have to calculate the goodwill before you know the impairments. Okay, what again? We don't need NCI unless the question is asking, because the NCI will go to statement of financial position. We don't need NCI. We don't need group retained earnings. We don't need group revaluation reserve. The only two things that you'll be needing is the group structure and the goodwill calculation. That is if you have been asked to do it, or if you have been given impairment loss in a percentage, you have to calculate the goodwill before you know the impairment. Then you also do you can now do other workings. Okay, you can do other workings. That will be the depreciation as a result of upwards revaluation, depreciation as a result of downwards. There will be an issue of, let's say, provision for unrealized profit. You can do other workings. Okay, but if you are doing statement of financial position, these are the ones that you are going to be showing. Okay, if you are not asked to calculate goodwill, or you are not giving goodwill, or you have given the impairment of goodwill in a figure, the only thing that you have to show over here is group structure plus other workings. You don't need to do net assets. You are doing net assets purposely to know the profit made after acquisition, which will be shared among the NCI and other words, the parent. You are doing the NCI because you want to know the NCI portion that will be in the statement of financial position. You are doing group retained earnings because you want to know the total retained earnings at the reporting date of the entity, which will be reported in the what? In the statement of financial position. We are doing statement of profit or loss now. So there is no need for those ones. Okay. But they can also give you both, a combined one. It means that you have to do this one. If you are giving, they can actually give you statement of financial position and statement of profit or loss. They will ask you to prepare the two. If you are preparing the two, it means that this is the things that you are going to be doing, because you need the goodwill, the NCI, and this one. So you'll be doing this one. But if you are doing this alone, this is the one that you are likely going to be what? Going to be looking for. Okay. I don't think I have any other thing to say again. I don't think I have any other thing to say again. But before that, I was just going through, okay, where is this one? Okay, let's go here. Okay, so this particular question about 12, okay, I was just going through this. I was putting the question together yesterday. I was going through and I realized that, okay, the financial reporting, your console was this question. Okay, it was this question, but they changed the figures. The wording, everything is still the same, but they changed the figures. Okay, it's a question that I had from somewhere, but what they have been doing is that they have stopped taking questions from that particular side, and that is why we didn't solve it the last sitting. It was part of the console questions, but we didn't solve it because they have stopped taking questions from that side. But I realized that it is the same thing that they brought. This one, the information, the footnotes, everything up to this level, even the top there. Okay, the purchase consideration was the same thing. Okay, this one too was the same thing, but just that they have changed the figures. Okay, the sales throughout the year, the same thing. This one, the issue about the investments in associates was the same thing. Okay, and the issue about the impairment loss too was the same thing, but just that they have given impairment one. Okay, so that is it. What I'm trying to say is that, okay, since they have now started picking questions from that document again, okay, it means that everything is possible. So I still have 2 questions there that they are going to be taking the question from. So that 2 questions will be the first 2 questions which we are going to be solving. Okay, there are questions on statement of financial position, and that is the first question 1, and question 2. So we start picking that one. Okay, we start picking that one now. Okay, so we solve the question on Wednesday. Done. We solve one. Then we continue with what? With Saturday. We solve, like, let's see, at least 6 questions. Done Saturday. Then we come and do final account. Then we are done. All right. Any issue? If there are no issue, I want to go back to where I'm coming from. Then we actually meet on what? On Monday. Okay, corporate reporting people, I will see you in the evening. And financial reporting, I will see you on Monday, Wednesday, and Saturday. Thank you all for coming. Have a good day. All right.
Thank you.
Thank you, teacher.